Hello friends, this is Prashant Daftary, partner NHI Associates LLP. Friends, today we will discuss one important amendment which had come few months back on the format for non-corporate entities. This amendment was initially understood to be mandatory because the guidance notes issued by the institute are mandatory for its members. However, institute recently has come out with a circular that the guidance note for this financial year is recommendatory, and hence it provided certain relief to a lot of people. Let us understand why this guidance note was required to be introduced. There were varied practices which were being followed by the chartered accountants as far as the non-corporate entities were concerned, and there is no format which is prescribed under law except for trust or maybe the societies and other things where there is a specific format which is prescribed under the law. For example, Partnership Act does not prescribe any format, or for proprietary accounts there is no format, and some of these partnership firms or proprietary entities could also be very large, and they could also be having bank loans, fundings and other related matters, and hence it is very important that those financial statements are of the desired standard and ensure that there are adequate disclosures which are made in those financial statements. Some inconsistencies which were there were as regards previous year figures, as regards disclosure of proprietors' balances or partners' current account balances. There could be issues as far as the disclosure of notes. Selected notes were disclosed, few notes were not disclosed, contingent liabilities. In some cases, those notes were not fully disclosed, commitments and other areas. The guidance note tries to bring about a standardization in various activities and the disclosures which are required to be given by the non-corporate entities, and the structure and the format of the final accounts. It prescribes the definition of the financial statement for a non-corporate entity because this would ensure that a complete set of accounts is presented. Now, the complete set of financial statement includes the balance sheet, statement of profit and loss, cash flow if applicable, notes to accounts and significant accounting policies. So this is something which is now very clearly prescribed, and hence there cannot be any scope for argument that it is not mandatory and hence certain disclosures are not made. Even though there were certain disclosures which are part of accounting standard, however, a view was taken that these accounts are prepared mainly from a tax perspective and hence some of these disclosures are not necessary. The guidance note also prescribes that the disclosures of assets and liabilities should be broken up into current and non-current, which is similar to what is followed for companies. The concept of operating cycle is also introduced. One of the important change which is going to happen is the disclosure of the current account of the partners. And there was a practice where current account of partners were either shown as current assets or current liabilities. Now it will be shown as a part of the owner's funds or the partner's fund, like another equity schedule. There is a separate line item for reserves and surplus also, which is prescribed in case the partnership firm does not transfer the entire profit to the account of the partners. There is a possibility that you show those as part of reserves and surpluses. The terminologies are in line with what is there for companies. It is trade payables and not sundry creditors. It is not profit and loss account, but it is statement of profit and loss. So these are some of the terminologies which we should be aware about, and we should ensure that those are followed while we prepare the financial statements. Another common terminology related issue is that the use of the words fixed assets. It is property, plant, equipment and not fixed assets, and hence we need to be careful about some of these changes which are prescribed. The disclosure of the partner's capital as a part of owner fund could have an implication, because if there are overdrawn balances by the partners, then there could be a scenario where the net worth of the firm could become negative, and those would drastically change how the balance sheet of that partnership firm is viewed by the readers of the financial statement. It is necessary to give proper disclosures as regards the loans which are taken, the terms of the loans, the securities and the other conditions relating to such loans. All loans have to be classified between secured, unsecured, and the disclosures, most of the disclosures which are required by the companies, like contingent liabilities, commitments, MSME related disclosures, forex related disclosures, they are all now prescribed as a part of the guidance note. Though this year the guidance note may not be mandatory, it is recommendatory, but it is advisable that we come as close to those guidance notes so that the transition becomes that much more easier and the clients can also be educated well in time. One key challenge which I foresee is on the fixed assets, because we have been used to following the block system of accounting. However, and the guidance note has prescribed that you need the disclosures as regards gross block, accumulated depreciation and the net block. Though these disclosures were already required under the AS 10, it was a common practice to follow the tax system of accounting, and hence these disclosures are not made. Now all of a sudden to bring those gross block and other details may be very difficult for some of the entities and could pose a practical challenge. However, efforts will have to be made to comply with that, and in case those disclosures are not possible, then there would be a need for a note in the audit report, because AS 10 non-compliance which was there from earlier years continues, as well as the disclosure of the guidance notes are not being complied to. Another area that we need to be careful is that the guidance note is also applicable to cash basis of accounting, where to the extent applicable, because cash system will have its own limitations where everything is not on accrual, but to the extent it is applicable, you follow the guidance note. So that is another important point that we should be aware about. Along with the guidance note, we should also carefully look at the applicability of the accounting standards. The erstwhile level 1, 2, 3, 4 are now MSME and non-MSME. Though by and large limits remain same, but the classification between MSME, non-MSME, and there are certain exemptions for micro entities, these need to be looked at carefully. Disclosures about whether the entity is a MSME, non-MSME is also something which requires to be made in the financial statement, so that the reader can understand the exemptions, if any, have been availed in as far as disclosures or recognition or measurement. So this is another area which we should be aware about while finalizing the accounts of non-corporate. Hope this information is useful to you all. Thank you very much.